Um, so if you enter into a forward contract, right? What do you think would be the main limitation of a forward contract? What? The time? What do you mean by time? The contract time is agreed upon by the two parties, right? So how it could be a problem? Yeah, why? There must be a reason for it, right? Very good. Okay, so they are not liquid, right? Okay, and of course default is fine as well, right? So they are not liquid, right? They are customized. I mean, the reason they are not liquid is because they are customized according to the needs of the two parties, right? And that translates into this problem that they are not very liquid, right? And also there is a high default risk, right? If let's say stock prices, if for example prices move in extreme fashion, right? Then one party would gain a lot, another party would lose a lot, right? So the default risk is quite high in that case, right? Okay. So the main limitation of forward contracts is that these are not very liquid, and there is a potential default risk. Okay. So another type of derivative contract that is similar in terms of its payoffs. That is similar to forward in terms of its payoffs, right? But it reduces the limitation of a forward contract in the sense that that forward contracts are not very liquid and there is a relatively high default risk, right? So we call these futures. So future contracts, right? So financial future contracts are similar to forward contracts in that there are, an agreement between the two parties, right, to engage in a financial transaction at some point in time in future, right? However, these differ from a forward contract in the following ways. So, first one, it's a legally binding obligation. So if you enter into a futures contract, you're legally obligated to fulfill the contract. Okay. So forward contracts were illiquid because they were customized. The price, the quantity, the time, right? And this customization makes them illiquid. So futures contracts are standardized, right? Unlike forward contracts, which are customized, futures contracts are standardized, right? And hence they are more liquid. Okay. So these are traded on stock exchanges, right? So which improves the liquidity, right? Their prices are quoted on the stock exchanges, and different parties can trade on these contracts. So it specifies the delivery of type of security at a future date. One key characteristic of futures contract is that they are marked to market daily. Okay, what does marking to market means? If there are fluctuations or changes in underlying assets. Okay, so customers who enter into a forward contract, I'll show you the process of it. So they are asked to, either put in money or they can withdraw money depending upon how much they have in the they have with the broker in their account. Okay, any changes in the price, right? So you would have to update your account with the broker. Okay. So because of this marking to market, it avoids or reduces the default risk from the other party. Okay. So for example, a party is making losses, they're asked to put in more money into their account with the broker. Okay, good. And these futures contract don't have to deliver. They're typically netted off. So cash netting off positions are taken in futures contracts. So rather than delivery of the actual good or underlying asset. So why do we have these futures contracts, right? So we just compared forwards and futures, right? So futures overcome some of the limitations of the forward contracts. In terms of its objective, the objectives are very similar to that of a forward contract, right? We use these future contract either for hedging or for speculation, right? Hedging is with the intent to manage or reduce risk, and speculation is with the intent to make some money, make some profit, okay? So speculators in a financial futures market take positions to profit from expected changes in the futures prices. So there are two different types of traders: day traders, who attempt to capitalize on price movements during a single day. So their positions are short term, right? They transact. If they long the contract, they try to close off that position by shorting the contract by the end of the day or within one day. And then there are position traders who maintain their future positions for a long period of time. As I mentioned earlier, hedgers enter into future contracts with the intent to manage their risk. And we have seen when we're discussing forwards, we've seen, there you can use these contracts, these derivative contracts, to manage your interest rate risk, to manage your exposure to exchange rate risk, right? Or any other risk that or to manage the risk in any other asset or portfolio which has an exposure or which has a price risk, right? Which is exposed to fluctuations in price. Okay, so how does the trading take place in a futures contract? To buy or sell futures contracts, customers are required to open an account at one of the brokerage firms. Okay, so they can't directly trade, so they have to open an account with one of the brokerage firms that execute future transactions on their behalf. So a customer must establish a margin deposit with the broker. So when they open an account, they have to put in an initial amount, a margin, which we call the margin deposit with the broker. And this is before they can carry out any of the transactions. This initial margin is typically between 5% and 18% of a futures contract's full value. Right? So let's say this is like 5%, for example, right? If the value of your future contracts goes up, right? So you would have the amount of margin that you need to maintain would also go up, right? Because 5% of a higher amount will be greater. Okay? Or if it goes down, right, then your margin requirement will also go down. I'll show you an example of this as well. So brokers commonly require margin deposits above the ones that's required by the exchange, right? So if, for example, exchange has a margin requirement of, let's say, 2%, the brokers would require a margin requirement above that, okay? To be, to reduce their risk. Right, okay. So types of orders that take place in the futures market. So we have a market order and with a market order, the trade is executed at the prevailing market price. And then we have a limit order. So the limit order is executed conditional on if the price is within a range that's set by the customer or that's determined by the customer. Okay, so with the limit order, trade is executed if the price is within the limit specified by the customer. So if we look at the role of future exchanges, right? So future exchanges, they basically act as a clearing house. What is a clearing house? It's like the third party, right? Which facilitates transactions between buyers and sellers of the contract, but does not engage in buying and selling on its own. Okay, so these future exchanges act as a clearing house. A clearing house facilitates the trading process by recording all transactions and also ensuring that payments are made in a timely fashion. So given that it records all transactions and ensures that payments are made, as I mentioned earlier, there is a margin requirement, right? So this reduces the risk that the other party would default, right? Okay. So this precludes the need for a purchaser of a futures contract to look into the creditworthiness of the seller of the futures contract, right? So these exchanges, because they act as a clearing house, they ensure that transactions will go through in a timely fashion. Okay, so it reduces the risk that the other party would default. Okay, so let's see how we can use futures to manage our risk. So here we have an example where we will try to reduce or manage our exposure to interest rate risk. So a manager has a long position in treasury bonds. She wishes to hedge against interest rate increases and uses T-bond futures to do so. So as I said, in terms of the payoff, futures are very similar to forwards, right? The gain of one party will be equal to the loss of the other party. But because forwards are customized contracts, right? They're illiquid. So we standardize them in a futures contract. So if she has a portfolio of these T-bonds that's worth 5 million, because these futures contracts are standardized, right? So each contract would have an underlying value of 100,000 pounds, right? So if she wants to hedge this portfolio of T-bonds that's worth 5 million, how many contracts does she need to buy? 50, right? So to fully hedge her portfolio, she needs to short, not buy, she needs to short 50 contracts, right? She needs to sell 50 contracts. Okay. Right, okay, so what will happen if the interest rates increase over the next 12 months? If the interest rates increase over the next 12 months, the value of her portfolio will go down, right? Which portfolio? The portfolio of futures contract or the portfolio of T-bonds? Portfolio of T-bonds, right? The portfolio of T-bonds will go down, right? Okay, let's just say, given that the interest rates have gone up, we assume that this increase in interest rate has resulted in a drop in the value of our portfolio by 1 million. So from 5 million, it dropped to like 4 million. Okay. So the market value of the portfolio goes down by 1 million, but given that she has shorted 50 future contracts on the, so the value of these futures contracts will go up by the same amount. Okay. So the T-bonds future contract, right? So their value in the market would have also gone down because the underlying security is the portfolio of T-bonds, right? But because she has sold them in advance, right? She has shorted those contracts, so she ends up making the gain. Okay, so the loss of 1 million is exactly offset by the gain of 1 million in her short position. Okay, so losses in the spot T-bond market are offset by the gains in the T-bond futures market. Okay, so she is hedged against interest rate risk. Okay, if interest rates go up, the value of her portfolio will go down, but by the amount with which its value has gone down, right, she gains the same amount because the value, she generates the same amount by shorting the futures contracts. So this is how a futures caught would look like on an exchange. So in the US, these futures are traded on Chicago Board of Trade Exchange and the Commodities Mercantile Exchange. So both of these are in, so that's in Chicago. The New York Futures Exchange, and there are other exchanges who deal with, who transact in these futures as well. So these are regulated, right? Like all exchanges, these are regulated, and in the US, these are regulated by Commodity Futures Trading Commission. The prices of financial future contracts for debt instruments are published in financial newspapers as well as on different internet sites as well. So the market is aware, what is happening with these futures contracts and their prices. A typical entry, the following one so this entry that I have, it's from the Chicago Board of Trades. That's has a standardized value of $100,000 Treasury bonds contract, and that's on June 23, 2006. Okay, so this is how it would look like, right? So one other characteristic of these future contracts is that the delivery or the settlement date is also standardized. Not only the amount of the contract, but also the deliveries are standardized. So the settlement takes place quarterly. So settlements will happen in March, June, September, and December. Okay. So that's why here these are the settlement dates, right? So September settlement, a futures contract, one futures contract that has a value of $100,000. The opening price is given, high, low, the settlement price, right? Okay, and then the changes with respect to change in settlement price with respect to the previous date, and open interest shows the number of futures contracts. Okay, so let's use this futures contract to hedge our foreign exchange risk. So let's take an example. A manufacturer expects to be paid 10 million euros in 2 months for the sale of equipment in Europe. So currently, if we assume that €1 is equal to $1, and the manufacturer would like to lock in this exchange rate, right? So how can the manufacturer lock in this exchange rate? They can either enter into a forward contract, right, with an exchange rate of €1 equal to $1, right? Or they can enter into futures contracts, right? But in futures contract, because these are standardized, so it has to be multiples of. So so one of the parties, so this manufacturer would need to buy multiple futures contracts. So the manufacturer can use the foreign exchange futures to hedge this foreign exchange risk. So this is the amount that the manufacturer needs to this is the amount that the manufacturer wants to make sure that the manufacturer will receive, right? So $10 million. Okay. So assuming that one contract is for $125,000, how many contracts does the manufacturer need to buy? So 10 million is the amount that he is exposed to, right? The manufacturer is exposed to. And one contract has a value of 125,000. So how many contracts does he need to buy? He needs to have 80 contracts, right? So 10 million divided by 125,000. Okay, so he needs to take a short position in 80 futures contracts. Okay, if he takes a position in less than 80, he wouldn't be fully hedged, right? He'll be, exposed to some foreign exchange risk. But if he wants to hedge all of this amount, insulate all of this amount from foreign exchange risk, then he needs to enter into 80. He needs to take a position in 80 contracts. Right, so the exchange will require the manufacturer to deposit some cash into the margin account, right? That's how these future exchanges operate, right? So for example, the exchange may require you to deposit $2,000 per contract. And given that the manufacturer wants to hedge 10 million, right, he or she needs to take a position in 80 contracts. So 2,000 per contract, 2,000 times 80. So the total deposit amount, that the manufacturer needs to deposit is 160,000, right? Okay. So as the exchange rate fluctuates during the 2 months, the value of the margin account will also fluctuate, right? Okay. So as the exchange rate will move, right, the manufacturer will either gain or lose, right? And because the margin is a certain percentage of the value of the portfolio, right? So the amount of money he needs to have in the margin account will also fluctuate as the value of the futures contract change over time. If the value in the margin account falls too low, then the manufacturer might be asked to put in additional funds into its margin account. So this is what we call marking to market. If additional funds are not deposited when they're required, the exchange will close its position on its own, okay, and do the settlement. Okay, so assume that the actual exchange rate is €1 equals 96 cents at the end of the 2 months, right? So if this is the actual exchange rate, right, what will happen? The manufacturer receives the 10 million euros and exchanges, and if the manufacturer exchanges them in the spot market, this is the amount that he will receive, right? $9.6 million, right? Given that exchange rate is 1 euro equals 96 cents. Okay, so you can see there is a loss of 400,000 here, right? Okay. So if the exchange rate is 0.96, there is a loss of 400,000. The manufacturer also closes the margin account. How much would be the value in the margin account? The value in the margin account will be 560,000 now. Why? Because the manufacturer has taken a short position, so the futures contract value would have gone up by 400,000 plus 160 that he deposited in his margin account, right? So the total value in the margin account will be 560. So 400,000 for the changes in exchange rate plus the original 160,000 required by the exchange. And assuming, so here we assume that there were no margin calls during the 2 months period, okay? No additional funds were deposited or withdrawn. So in the end, the manufacturer has 100,000 pounds, 10,000, $10 million as was the as desired from the sale to the from the sale in the European market. Okay. Right. So if we look at this, contract again, and we assume that instead of exchange rate being 0.96 dollar per euro, if the exchange rate is instead $1.04 per euro, right? So in this case, the manufacturer, right? In this case, if the manufacturer exchanges the 10 million euros that the manufacturer receives in 2 months' time, if the manufacturer exchanges that in the spot market, he will end up $10,400,000. Right, so there is a gain of 400,000 in this case, right? But this gain of 400,000 will be exactly offset by the loss of 400,000 in the short position in the AT future contracts that the manufacturer had taken. So the two will net off again, and the manufacturer will end up 10 million. Will you be, if you are the manufacturer, right? Will you be happy in this scenario? Will you be happy in this scenario? Yes or no? Probably not, right? Because had you had not entered into these futures contracts, right? If you had not shorted these 80 futures contracts, you would have gained $400,000, right? So this gain of 400,000 in the spot market is offset by your loss in the 80 future contracts that you shorted. So again, if you look at the payouts, these are identical to what we have seen in the forward contracts, right? So the gain of one party will be equal to the loss of the other party, right? So here we have profit or loss from purchasing a future contract. So that's taking a long position into the future contract, right? Okay, and this horizontal line represents the exchange rate or the price if it's any other asset. And this side represents the gain or loss from shorting a futures contract, right? Okay. So the gain of one party exactly equals the loss of the other party. Okay. So remember I told you about this marking to market, and that ensures that the default risk is minimized. Okay, so the counterparty doesn't default. Okay, so I know there is a lot of text in this slide, so we'll go through this together, and I'll try to go through this relatively slowly so that we all are on the same page. Okay, so suppose an investor has $1 million long position in T-bonds futures. Okay, so the investor has bought these T-bond futures worth $1 million. The investor's broker requires a maintenance margin of 4%. So when you enter into this forward contract, you have to put in 4% of the value of this asset, value of your portfolio, right? Okay, so 4% of 1 million is 40,000. So when you buy these T-bonds futures, and if its value is 1 million, you have to put in 4%. So you'll deposit 40,000 into your maintenance margin account with the broker. Okay, now suppose that the value of futures contract drops by 50,000. Okay, so we started with 1 million. Now the value of the portfolio dropped by 50,000. What do you think would have happened to interest rates? Going up. Okay. So T-bonds values would have gone down. All right. So if the value of this portfolio goes down by 50,000, so now the value of the portfolio is 950,000, right? From 1 million, it dropped to 950,000. So how much investor is now required to maintain in the margin, as maintenance margin? 4% of 950,000, right? Okay, and 4% of 950,000 is 38,000. Okay, initially the investor put in 40,000. Now the value of the portfolio has gone down, so the maintenance margin requirement has also gone down, and the difference is 2,000, right? From 40,000, it has dropped to 38,000. So now she has a surplus of 2,000. So if she wants, she can withdraw 2,000 pounds, $2,000 from her maintenance margin account. Okay. Right. Okay. Further, because futures contracts are marked to market, the investor's broker will make a margin call to the investor, requiring him to immediately send in a check for 50,000 minus the 2,000 surplus that she has in her account. Okay, so that will leave 48,000, leaving him with an account balance of 38,000 at his broker for the value of the portfolio that she holds now, amounting to 950,000. Okay, so if the next day the future contract drops in value by another 40,000, right? In that case, the value of the portfolio would be 910,000. So the investor is now required to hold only 36,400 as maintenance margin, right? Which is 4% of 910,000. Okay, so how much does he have surplus now? Maintenance margin 38,000 previous. Now the requirement is only 36,400. So the surplus is 1,600. Okay. But because the value of her portfolio has gone down, right? Okay, because futures contracts are marked to market, the investor's broker will make a margin call to investor requiring him to immediately send a check for the loss that has taken place minus the surplus that she has in her account. Okay, so the investor would need to put in additional 38,400. Okay, so you can see as the value of the portfolio goes down, right, investor is making losses. As she's making losses, she is putting in more money to compensate. So she's clearing up at the same time, right? She's covering up her losses by putting in additional money. And if the reverse happens, if the value of the portfolio goes up, right? Okay, then she will have an inflow of cash. So that's what happens in the third case, on the third day. So if on day 3 the future contract increases in value by 65,000, so the value of the portfolio will be $975,000. So in this case, investor's required margin is 4% of 975,000, okay, which equates to $39,000. Okay, in this case, now he has a deficit of 2,600. Why? Because previously his account balance was 36,400. Okay, now the margin requirement is 39,000, and the difference between the two is deficit. So he needs to have 39,000 in his maintenance margin. He only has 36,400, so he needs to top up, right? So the difference is 2,600, which is the deficit. So he needs to top up his maintenance margin. But because the value of the portfolio has gone up, right? So the broker will send him a check of 65,000, which is the value with which the portfolio has gone up, less any deficit in his maintenance margin account. Okay, so 65,000 is increase in the value minus any deficit in the maintenance margin account. So he will receive $62,400. Okay. Right. So as this example shows that the marking to market feature of these future contracts can lead to unexpected cash inflows and outflows during the life of the contract that you for the period you retain the contract, right? If the value of the portfolio goes down, right, you might have to put in more money to compensate for the losses. If the value of the portfolio goes up, you can withdraw that money, right? The broker can give you that money. Okay, good. So you can see it leads to uncertainty in the cash flows, because the cash flows that will take place will depend upon how your portfolio is doing. Okay, so you need to either put in money or you may be entitled to take away some money, depending upon how the portfolio is doing. Okay, so you can have futures contract on stock indices as well. So stock index futures are a contract to buy or sell a particular stock index, which has a given starting value. So you can so contracts exist for major stock indices such as S&P 500 or Dow Jones Industrial Average. Okay, so the best stock futures contracts to use is generally determined by the correlation between the returns of your portfolio and that of the index that you're using. Okay, So if you want to reduce your risk or manage your risk using futures contracts, you need to use a future contract on an index that has the highest correlation with your portfolio. So let's say you have a portfolio of different firm stocks. It's an equity portfolio, right? Not the debt portfolio anymore. So if you have a portfolio of equity stocks, you need to identify an index that moves together with your portfolio. Okay, the greater the correlation, okay, the better it is for hedging purposes. Okay, so let's look at an example. So Rock Solid has a stock portfolio worth 100 million, which tracks closely with S&P 500. Right? So the first thing you need to do is to look at your portfolio and see which index does it follow. Or better, so what you have to do is to look at the correlation between the returns of your portfolio and other stock indices. Okay, and you need to select an index that shows the highest correlation with your portfolio. Okay, so in this case, the portfolio follows S&P 500, right? So we'll hedge using S&P 500. The portfolio managers, if the portfolio manager expects a decline in the market in coming days, so what will you do? If you are a manager, right? What will you do? You hold an equity portfolio and you expect that a decline is coming. What will you do? If you keep on holding the portfolio, right, the value of the portfolio will go down, right, and you will lose money. So if you expect that the value of the portfolio will go down, what will you do? You short sell it, right? You sell it in advance. Okay. So if the S&P, so the portfolio that she holds follows S&P, right? So what she will do? She'll buy contracts. She'll basically short contracts in S&P index, right? Okay, so if the S&P is currently at 1,000, okay, so how will you accomplish this hedging? So the value that you need to hedge is 100 million, right? Okay, so so you have to determine how many contracts you will short. So here is the formula for that, right? 250 is the value of a contract, and you multiply it with the index value, the starting index value, which is 1,000. Okay, so 250 times 1,000, that's the value of one contract. So 250,000 will be the value of one contract on S&P 500 future. And given that you have to hedge 100 million, right? Okay, and we assume that there is like 1-to-1 correlation or perfect correlation between S&P 500 and your portfolio. So you will short, right? You will sell 400 contracts on S&P 500. Okay, so 100 million divided by 250,000 is equal to 400 contracts. So you'll need to short 400 contracts to perfectly hedge your portfolio. Okay, suppose after the year the S&P 500 is at 900. Okay, if S&P 500 is at 900, what is the value of your portfolio? Given that there is perfect correlation, right? So the value of your portfolio will be 900. I'm sorry, 90 million. 90 million, right? Okay. Good. So your portfolio has gone down by 10 million, right? But because you have shorted these futures contracts in advance, right? So the gain in the future contract will be 10 million. Okay, so the total value is still 100 million, right? And the reverse is also true. If the S&P 500 is at 1100 now, so the value of your portfolio will be 110 million, right? So you'll gain 110 million. But because you have shorted these 400 S&P 500 futures contracts, you'll make a loss of 10 million there. Okay. So your net position in either scenario is 100 million. Okay. So you can see you can hedge the value of your portfolio by shorting these futures contracts, and you have to identify. But for that, you have to identify an index that closely follows, or your portfolio follows their return. Okay, so the portfolio is, you can see the portfolio in this case is protected from the downside risk, right? If the value of the portfolio goes down, right? So if the price of S&P 500 goes down, we have seen that the value of the portfolio gets reduced by 10 million, but because you shorted the contracts in advance, you end up making 10 million there, so you still end up with 100 million. So it protects you from the downside risk. Okay, but the drawback is that it also restricts you from making any gains. Okay, so in the later case, if the value of the portfolio has gone up, you don't end up with 110 million now, you still end up with 100 million. Okay, so the portfolio is protected from downside risk, the risk that the value of the portfolio will fall. However, to accomplish this, right, there is a cost, right? The managers have also eliminated the potential of upside as well. Okay, so can we have a strategy that protects against the downside risk but does not sacrifice the upside? Okay, can you think of any strategy that protects us from the downside risk but does not limit the upside gains? Very good. So if we want to protect only the downside risk, right, but do not want that if the values increase, okay, and we do not lose out, so we can use options. Okay. Okay, so the answer to that is we can use options, and I'll show you, I will talk about options in a few minutes. And I'll show you how options work. Okay, but before we do that, let's have a look at cross-hedging. Okay, so cross-hedging is the use of a futures contract on one financial instrument to hedge a position in a different financial instrument. Okay, so let's say you hold Facebook stock, for example, right? Okay. And let's say there is some restrictions on Facebook stock that you cannot short it, right? So what will you do? You'll have to short a stock that closely, whose return is closely related with that of Facebook. Okay, so you're not using the original asset in this case because of limitations, right? So in this case, you're using another asset. to hedge. Okay. So futures contract on one financial instrument to hedge a position in a different financial instrument. So the effectiveness of this cross hedging would depend upon the correlation. The more closely related the two assets are, the better the hedge. Okay. If those two assets are perfectly correlated, then you don't have to worry about anything, right? Then you're perfectly hedged. Okay. But it's extremely difficult to find instruments or assets that are perfectly correlated. Okay, so you will have to find out the best. Okay, good. Okay, another thing that you should potentially do, and I think someone asked this question earlier as well. So how much position should we hedge, right? Should we hedge all of our position or some of it, or okay? Because hedging is costly, right? There are transaction costs, right? There are fees that you have to pay. So instead of taking complete positions, so you have to take a position in the net, in your net exposure, right? So future contracts entail transaction costs. They should be used only to hedge the next net exposure, right? Which is the difference between assets and liabilities positions, right? So for example, if you export something to US, right? You manufacture something and you export it to US, right? So you will receive dollars. So you're exposed to foreign exchange risk. But also, let's say you import things from US for your manufacturing process, right? So you'll have to pay them dollars as well. So you have an inflow of dollars when you make a sales, but you also have an outflow of dollars when you purchase from US. Okay. So instead of taking complete positions on all of your inflows and all of your outflows, you should look at the net. Okay. So let's say you make sales of 10 million and you buy goods worth 8 million. Okay. So the difference is 2 million. So you should catch only 2 million rather than 18 million. Okay. Good. Okay, so this is how it helps. This is how hedging works. So this is the distribution of unhedged positions. Okay, so you can see the distribution is quite wide. So what this means is that the probability of making extreme losses are quite high, and the probability of making extreme gains are quite high. But when you do a hedge, right? So your distribution is more like this red one. So it narrows down. Okay, you get some sort of certainty, right? So probability, so you're basically eliminating the possibility of extreme losses and extreme gains, okay, when you use hedging. So the hedge position limits both your upside as well as the downside, okay? So that's the advantage. So this is basically a reduction in risk, right? You're more certain that you're more likely to earn this return. Okay. Right. Okay. So I asked you this question earlier. So with forwards and futures, if we enter into these contracts, we reduce our downside risk, but at the same time, we eliminate our potential to gain from upside as well. So options are contracts that limit our downside potential, but does not limit our potential to increase in value. Okay, so what is an option? An option is a contract that gives the holder the right, but not the obligation, to buy or sell the underlying asset. So it's still a derivative security because its value depends upon another asset or another security, right? But it's different from forward and futures, because in those cases you would have to, you're obligated to complete the contract, right? With option, as the name suggests, it gives you the right, but not the obligation, okay, to either buy or sell the underlying asset at a specified price within a specified period of time. So calls, so a call option is when you enter into a contract that gives you the right to buy the asset, buy the underlying asset at a specified price at some future date, specified future date. Okay. So call options give purchasers the right to buy an underlying security at a pre-specified price, and we call that exercise price or strike price. Okay. So is this costly? So given that it's not an obligation, right? So it gives you the right. Okay, so let's say we enter into a contract that gives me the right to buy a stock at the strike price, which is predetermined, right? Okay. So let's say that strike price is $20. And what is the date today? 14th. Okay. So let's take it next week, right? So let's say 21st. Okay. So the expiry date of the contract is 21st. Okay. So on 21st, if the actual price of the stock is 25, what should I do? I should exercise it, right? Because this contract allows me to buy the stock for 20, right? Okay. So I'll end up gaining 5. If, for example, the stock price is less than 20, should I still buy it at 20? No. Why?
You cannot exercise the option.
Yes. But why shouldn't I exercise the option? Because I didn't buy it in the market for less, right? Okay. So in that case, I should not exercise the option, right? Okay, because I can buy the stock at a lower price in the market. So it gives me flexibility. The owner of the option gets the right to decide whether to exercise the right or not to exercise it. Okay. So the owner of an options contract, right, has this flexibility. So if so this flexibility should come at a price, right? Because nothing is free. Okay. So this flexibility comes at a price. Okay. In return, so when you enter into call option, that gives you the right but not the obligation to buy at a specified price. So in order to get this call option, the buyer of a call option must pay the writer or seller of the call option an upfront fee, which we call the call premium. To get this right, you have to pay a premium. Okay? And this premium is paid upfront. So the opposite of this would be a put option, which gives the seller, which gives the option to buyer. So put option gives the buyer the right to sell an underlying security at a predetermined price, which we call the exercise or strike price, right? So put option gives the right to sell an underlying asset at a pre-specified price to the writer of the put option. So again, if you buy a put option, you can sell at the strike price, but you don't really have to. Okay. So in order to, again, just like call option, in order to get this right, you have to pay a premium, which in this case we call the put premium. Okay, which gives you the right to sell at a specified price at some future date, but not the obligation. So there are two types of these option contracts, an American option and a European option. The main difference between the two is that you can exercise your option at any time before the expiry date in an American option. Whereas in the European option, you can't exercise it during the you can only exercise it at the expiration date. Okay, so you can't exercise it during the period. Okay, only you can exercise at the expiration date in a European call, in a European option. So it has nothing to do with geography. So the names are reflective of the type of the contract, type of the option contract. It doesn't mean that American options are sold in America and European options are sold in Europe, right? Or traded in Europe. Okay. Good. Okay. So how would you decide whether you should exercise your option or not? So we will exercise our right if it provides us with some value, right? Okay. So we classify options into three categories. At the money. So at the money options are options whose exercise price is equal to the current stock price. So we call it at the money because you are kind of indifferent. You can, if you exercise the option, you buy it at the same price. If you don't exercise it, the market price is the same as well, right? So you can buy it from the market at the same price. So we call it where the strike price is equal to the current stock price, we call it at the money. In the money, options are ones where the price is above the exercise price. Okay, so in the money options, so here I'm referring to call options, right? So in the money, so it describes an option whose value, if immediately exercised, would result in a gain. So if we talk about a call option, right? In the money would be where the current price is above the strike price. Okay? Where the market price is above the strike price in the case of a call option. And out of the money, if you exercise it, that will result in an immediate loss. So we call it out of the money market. And then we have like two extreme examples of it. So deep, we call it deep in the money and deep out of the money, right? Where the difference between the current market and the strike price is quite huge. So if it's deep in the money, it would result in a big gain. If it's deep out of the money, it will result in a big loss. Okay, so the person who buys the option, okay? So the person who buys the option has the right to exercise the option and we call it that the person has a long position in the contract. The person who sells the contract, who sells the option, we also call it the writer of the contract, is actually the person who is obligated to fulfill the contract, right? And so the writer of the contract has an obligation, but the buyer of the contract has no obligation. The buyer has a right, the seller has an obligation in an options contract. Okay, so the buyer, because the buyer has the right, buyer pays a premium to the seller. Okay, so stock options are traded on stock exchanges, on organized stock exchanges. By convention, all traded options expire on the Saturday following the third Friday of the month. Okay, so that's just by convention. That's how options trade. So here we have a quote on the eBay stock. So on the left hand side we have call options, and on the right hand side we have the put options. Okay, so you can see here these are different call options with different strike prices. Okay, so for example, this one for September 21, the strike price is 32. This one, January 18, right? Strike price 30, right? So different call options with different strike prices, and that's how they are quoted on an exchange. Okay, so these are different call and put options for the eBay stock. So we see the last sale, we see the net, and we have the bid and ask prices. We see the number of trades taking place in terms of volume, and open here means the number of contracts that are available. Okay, good. So if you buy one of these option contracts, at what price will you buy it? Bid price, ask price? At what price? Ask price. Good. Okay, good. So let's take an example. So let's say it's the afternoon of September 10, 2018, and you have decided to purchase 10 January call contracts on eBay stock with an exercise price of 35. Okay, so where it is? It should be 18th January, right? Okay, what is the exercise price? 35, right? So here. Okay, good. Okay, so this option expires on 18th January, right? Okay, good. Right, so because you're buying, right, you must pay the ask price, right? So how much money will this purchase cost you? Is this option in the money or out of the money? So this is the current price, right, of eBay stock, right at the top. So 33.75. Okay. So how much money do you need? So we know from the table, we know each option you'll buy it at ask price, right? You'll pay the ask price to get this contract. So each option costs you 1.66. Okay. And let's say you're purchasing 10 contracts, and each contract is on 100 shares. So if you buy one option contract, that's for 100 shares. So the transaction will cost you 1.66 per option, and you're buying 10 options, and each option has 100 shares. So 1.66 times 10 times 100. So in order to get this option, you'll have to pay 1,660, and this ignores any brokerage fees. Okay. So because this is a call option, right? And we know that the exercise price of this call option is 35, right? Okay. Is this in the money or out of the money? So the current stock price is 33.75. Okay. So this call option gives you the right to buy it at 35 because the current price is lower than the strike price, right? So you would prefer to buy it from the market. Okay, so at this stage, at this moment, this is an out of the money. Okay, so this is how the payoffs would look like, right? So if you take a long position, which means if you buy an options contract, right, the value of the call option at expiration would be as follows. So the value of the call option will be the maximum of the difference between the spot price at maturity, right, minus the exercise price or strike price. Okay, so if this difference is positive, you'll get the difference, right? Otherwise, you'll get 0. Okay, so whichever is higher. Okay, maximum of S spot price minus the exercise price or 0. So here S is the stock price at expiration. Sorry, S is the stock price at expiration. X is the exercise or strike price. VC is the value of the call option, and the max is the maximum of the two quantities in the parenthesis. So this is the value of a call option, right? So how much profit will you generate? The profit will be the value of this call option minus the call premium, because you paid a premium, because you paid a price to the writer of this call option. Okay, so the profit or loss will be the value of this call option minus the call premium that you paid. Okay, to get this right. Yep. Okay. No. Yep. What does 0 mean? Okay, it means, so it means the value of this option is either this bit or this. So 0 means that you cannot lose money, right? So because it gives you a downward protection, you can't lose. Okay. So remember when we spoke about forwards and futures? With forwards and futures, you have downside protection, but you also forego the upward gains, right? But with the call option, it gives you the downward protection, but does not limit the upside gains. Okay, so the first part is the gain part. So which means this is what you will gain. Okay, I'll show you an example. Okay, so remember this. When I'll show you an example, you will see how this translates. Okay, so this means if, let's say, you enter into a call option and the call option has a strike price of 20 on a stock, right? If the stock at expiration, if the stock is trading at 25, okay, will you exercise your option or not? So this call option gives you the right to buy that stock for 20, right? If the stock price at expiration is 25, will you exercise your right to buy will you exercise your right to buy the stock, or will you forego it? Exercise the right, okay? Because you can buy the stock for 20, right? So you will make a profit of 5. So, okay. So think about this, that you can buy, okay, you can buy at 20, right? So that's the option price, right? Okay, this is the strike price. Okay. And if the actual price is greater than this exercise price, let's say this is 25, right? So you'll get a stock that's worth 25 by paying only 20. Okay. So what is your gain? 5, right? Because you can buy for 20 and sell it in the market for 25. So your gain is 5, right? Okay, that's the value of this option. S minus X. So this is S, current price, minus X, which is the strike price. Okay, and the difference is your gain, right? Okay, so now let's suppose if this price is 18. Okay, 18 minus 20. So this would be -2, right? Will you buy it for 20 now? No, because you can buy the same stock in the market for 18, right? So you will not exercise. In this case, your gain is 0. Gain of, in this case, your loss is not 2 because you didn't buy at 20, right? Okay, so your gain is 0. You're not incurring a loss of -2, because if this was a fixed contract that you must buy it at 20, then you would end up with a loss of -2. But it's an option, right? So you will not buy it at 20. As a result, your loss is 0. Okay, so that's what it says. Either this or 0. So it limits your downside protection. It gives you the downside protection. It also doesn't limit the upside gains. Okay. But if you want to calculate the profit, right? In order to get this option, you have to pay a premium, right? Which we call the call premium. So from the value of the option, if you subtract this call premium, that gives you the profit. Okay. Good. Okay. So what this means is, so if the strike price is 7.5, as long as the price is below this, you will have a loss of 1.3. Okay. As the strike price goes up above 7.5, you start making some gains, right? You will exercise it, but in the first bit, you need to cover this 1.3 premium that you paid. So 7.5 plus 1.3 is 8.8, right? When the price is 8.8, your profit is 0, right? And if the price goes above 8.8, then you'll make a profit. So this is, so it brings me back to the question that I asked you earlier. Is this a payoff of the call option function, or is it the profit function? So this is essentially a profit function, right? Because it takes into account this payment of call premium, right? So it already subtracts that. Okay. Right. So payoff of a short position in a call option, right? So we know what does short position mean? It gives you the obligation to complete it if the holder of the call option exercises it, right? So because you are the writer here, you're writer of this call contract, right? You're selling this call contract, you will receive this call premium upfront. Okay. And we know as long as the price of the stock remains below 7.5, it will not be exercised, right? So your gain is this call premium. But as the price increases, right? So the seller of this call option will start losing money. Firstly, it will lose this call premium and will lose all of the call premium when the price reaches $8.8. Okay, and if the price goes above $8.8, then the seller will have losses. Okay, good. Any questions here? No? Okay. Right, okay. I know that it's a lot to take in, right? And these trading strategies can be very complicated. But I'm sure once you go back home and look at these again, you'll find you'll be more comfortable. Okay. Okay, so we can write the function of, so it's just like we wrote our call option, we can write the payoff of a put option as follows, right? Okay, what is the put option? It gives you the right to sell at a particular price, which is X, right? Okay, and you will only sell at X if it is greater than the spot price. Okay, so the value of a put option is the maximum of this, right? Either X minus S or 0. So again, it gives you the downside protection, but doesn't limit any gains from decreases in price. Okay. So the profit function is written in a very similar fashion. So value of this put option minus the put premium that you paid. Good. So this is how the payoff would look like, right? Okay. So what do we have here? We have a long position in a put option. Okay, because you're buying this long position, okay, you have to pay a premium, right? So premium for this put option is 65 cents. Okay, so as long as the price is above this value, will you exercise it? Will you sell it? You'll sell it in the market, right? Right? If the price goes below the exercise price, then you will have gains, right? So as the price falls down, put option becomes in the money. Okay, and the reverse is also true if you have a short position. Okay, if you have written this, if you have sold this put option, right, then you will have losses as the value as the price goes down. Okay, so we're running out of time. I'll just quickly mention some of the factors that affect the option prices. Okay, so there are a few slides that explain these as well. Okay, a lot of it is self-explanatory, but I'll quickly mention these factors. So what are the factors that affect the value of these options, right? Call and put options. So we have written this function here as well, right? So it depends. It should depend upon the spot price. It should also depend upon the strike price, right? Okay. So spot price and the exercise prices affect the value of these options. Another factor that's really important is the time to expiry. The longer the time, the greater the chances that the stock prices will move in a way that may benefit the option holder. Okay, so that would affect the price. A really, really important factor is the volatility, which we also call the risk, right? So the greater the volatility, which means the greater will be the fluctuations in the price, okay? And greater the fluctuation, the greater the chances that the option might, at expiration, it might be in the or out of the money, right? In extreme movements, right? So the riskiness of the stock affects. And the last one here is the risk-free interest rate. So why do we need this risk-free interest rate? If you think about this, so this is basically, we use this rate for discounting, right? So the strike price is a future cash flow if you exercise the option, right? Yes. So you need to have a present value of it, right? So a risk-free rate also affect the value of the options. One of the factors that I didn't mention here is the future dividend, because we are talking about stocks and stock pays dividends, right? So I haven't included that there in the list because not all stocks pay dividends, right? But if, for example, you hold an option contract on a stock that pays dividend, right? How it would affect the price? So dividends, when the company pays dividends, the value of the stock goes down, right? So from a call option perspective, it's a bad news, right? Because call options are only valuable if the price goes up. But from put options point of view, it's a good news, right? Because put options are valuable when the price goes down. By paying dividend, prices go down, right? So put options benefit from dividends, and call options have a decrease in value from dividends. All right. I have a few more slides on different combinations of trading strategies. The last thing I want you, when you go back home, is to look at this trading strategy, which we call put call parity, right? Okay, so when you go home, have a look at this, and if you have any questions, you can ask me before the next session and we can go through it. If everything is clear, then we don't have to, right? Okay, all right, so I'll see you later today.